G'day expats, welcome to another episode of Expat Chat, episode 53. And as always, joined with my co-host, friend and colleague, Brett Evans, who is the Managing Director for the EMEA region. Brett, how's the desert treating you today? Or I should say the sandpit, sorry.
Yes, mate, either or. They are interchangeable and all well here, thanks. All well. It's starting to quiet down in this region as people flee for the summer break. And for the lovely folks and listeners out there, joined by my mate and colleague, James Ridley, who's the Master of Australia, and he looks after the Australian office and specialises in our Asia and America's clients. So, mate, apart from wet and cold, how's Oz?
Well, I mean, yeah, the start of the week, it's been very wet. Unfortunately, New South Wales, they're copping it again. There's already flooding across 23 urban areas. They just can't seem to get any relief. They've recovered and then they get hit again. In Queensland, there's some areas that have been affected, but today, and I think the rest of the week and next couple of days, we actually just have blue skies. So that's really nice.
Yep.
But mate, pretty good. I'm a bit of a sook when it comes to cold weather.
You haven't had the thickening of the blood? Yeah.
No, mate, based on my date of birth, beach baby. So, and summer baby. But when we get these cold fronts where it's 4 or 5 degrees in the morning, that's ridiculous for the Gold Coast. Come on, shake it up. But mate, let's dive into today's episode. And I mean, one thing we've seen last couple of weeks, I want to talk about currency. What's going on? US dollar index.
A lot going on there. A lot going on. A lot of client questions going on. Where do we see it going? What's happening? So let's dive into US dollars, AE dollars, euros, pounds, the whole lot. Before we go any further, just do a little quick disclaimer. All information that you are about to have the privilege of listening to and watching should be taken as general or entertainment purposes only. If you need to get advice, speak to a professional who's licensed and accredited like Atlas.
Absolutely, mate. Absolutely. Now, currency or currency wars, whatever you want to call them, just seems to be a fair bit going on at the moment with the US dollar. I mean, I think we've always seen the US dollar as a safe haven, but what's causing the recent retracement? Do you think it is the safe haven theme? Is it other factors playing into it?
No, it's what we call risk on, risk off. So right now, risk is off. Obviously the central banks have been talking recession and all these sort of things and talking doom and gloom. So investors have got a little bit nervous. And what they've done is they consolidated their currency exposure to US dollars. That's sort of like the default. When you're playing a video game, you hit reset and start again. That's what US dollars are. So when investors are managing diverse portfolios, currencies, equity markets, and so forth, they're obviously trying to manage their risk. When things, we go through scenarios like we are right now, the interesting part is actually, they sort of consolidate just to ride out the storm. And that's what we're seeing right now. When we look through the numbers, certainly when we look at the US dollar index, which is a basket of US dollar exposure to other currencies, it's actually at a 20-year high. The last time it was at this level was back on the 27th of November, 2002. Now, for the learned audience out there, the first thing they're going to say to me is, well, wait a minute, the Australian dollar was lower against the US dollar back in 2020. So that's not 20-year
that's
high.
Right.
But what it is, it's an averaged basket, of exposure to across all the currencies, not just individual currencies. So if we go through and break it down, looking at, say, US dollar to euro, that's near a 20-year high. US dollar to pound, 26-month high. US dollar to AEDs, a 25-month high. New Zealand, 25-month high. Singapore dollar, 25-month high. Canadian, 19-month high. But when you take all that into account, it's actually at a 20-year high. So for the vast majority of expats, who are earning US dollar or US dollar linked earnings, so that's obviously US dollars, Hong Kong dollars, dirhams, Saudi rials, Qatari rials, Kuwaiti dinars, a lot of those things that have that pegging to it. That's good news.
Yeah. Very good news.
Good news. Will it go further? Yeah, possibly. I think the main thing we've got, the only thing that's, if we look at the Australian dollar in particular, the only thing that's going to upset that apple cart is if the RBA increases rates out a step in terms of what the market expects, or B, commodity prices change dramatically either up or down. So at the moment, if it's pari passu, things stay the same or within expectations, then it is going to bumble along at the moment, 67, 68. But we could see catalysts drive it higher or lower over the next 3 to 6 months. My gut tells me it could drift a little bit lower. Like we've said in our end of financial review call, and the webinar, and our podcast channels, we're in for a bit of a volatility over the next sort of 3 to 6 months as things work out. But also in saying that, we've got earnings season coming up. Companies reporting the 30 June results. The investors may take umbrage in the fact that the earnings season isn't as bad as the picture that the central banks painted. So we may see this re-rating process very quickly. In that case, people will start to move out of US dollars into other currencies. And I think an important point to note to a lot of folks out there is the Australian dollar is considered a developing currency, not a developed currency. So when you're looking at what is a developing nation versus a developed nation, there's a lot of moving parts behind that. But from a risk point of view, that's how they view Australian dollars. Even though when you look at Australian dollars, I think we're the fourth or fifth most traded currency in the world. But we're still considered sort of the rung below a sterling or a euros or a yen type scenario.
Yeah. And I mean, it's interesting, knowing that, it is the major trade currency, and obviously everyone's taking a risk-off approach, which means, moving into the US dollars, hold them, and riding out a bit of volatility there. I do find it interesting that the US dollar is at an all-time high from that average index against a lot of other currencies, yet there's also this buzzword going around in the US right now, recession, whether, they're going to fall into recession. Do you think if that became more of a key factor or something that was happening? And I guess to our listeners, on paper, the definition from a theoretical perspective of a recession is 2 back-to-back quarters contracting. It's nothing major. It just means that economy is contracted a little bit. It happened to everyone through COVID, but then everyone pulled out of it very quickly.
Yeah.
But do you think if the US slipped into a recession, probably a very short one, if anything, do you think people would go, US is in a recession, we might move out of the major trade currency because we're not sure how that's going to impact that? Or no, do you think people would still keep in the US dollar?
I think if the recession looked prolonged, so let's say, for example, we had a stagflation scenario where, we have inflation runs rampant with no economic growth, then we are going to be coming issue into a longer prolonged, recession. In that case, the default is cash. It's the mythical grandma with money sitting under a bed, but in a digital form in terms of holding cash in the bank. So the reset button is US dollars. The big question is right now we're seeing people increasing exposure, not totally dumping all the currencies, just going to US dollars. That's what we saw back in March 2020 with COVID, with the Australian dollar when it got down to 56. That was just a flight to US dollars. To me, it could be just a grind, and I think it's a great case. I mean, you and I always talk about DCAing, dollar cost averaging, when it comes to transfers. Case in point, if we had these sort of volatility aspects to both equity markets and currency markets, but the catalyst is always different every single time. What turns the narrative and what brings better peace of mind to people. It could be Vladimir Putin dropping dead tomorrow. It could be there's so many things that run through my head in terms of what could be that positive narrative that is more of a not specific data driven, but a big picture. The end is in sight, or the future looks better in the coming down the track. So to me, it's those sort of things that could do it, but we never know when those things are going to happen. Yes, the Australian dollar, when you look at the commodity prices and our GDP and those sort of things, should be around the 75-cent mark. At 68, it's a discount.
Well, it's an interesting point you make there about GDP. I mean, I've been talking to a few clients about this recently, because when we look at sort of unfortunately, it takes so long for our data to come out in Australia. It's why it's the RBA is driving forward, but trying to drive forward by looking in the rearview mirror. You token that one well. Now, GDP growth in March, that was still pretty strong, 0.8%. 12 months, that's 3.3-ish. And then you look at everything that Australia had to deal with in that quarter. We had that Omicron wave, which actually did cause a lot of the labour force to, shut down a little bit. Absolutely. And you also had New South Wales floods, which were just crazy. And that was also in Sydney as well. This wasn't in areas or rural areas where, there's not much population density. This was in big areas, cities, and we had it up in Queensland as well. You had all that to deal with, but yeah, we still grew. So the fact that you sort of had this period for, I would say, the June quarter where you didn't have those, I suppose, natural disasters to deal with. Omicron somewhat, we actually got a hold on, and we all just went back to work. I actually think the June quarter is actually going to be quite a good period of growth. I think we'll post a figure that's above 1%. I'm sort of wanting to bet 1.2, 1.3%, to be honest. It was really interesting to see the RBA minutes come out and Governor talk at the National Press Conference this week. And his notes were more so, households need to stop spending. If they stop spending, well, it's going to lower demand. If that lowers demand, or that will help with inflation. All I can do is raise it. It's just, there's a lot of mixed information that keeps coming out. And unfortunately, the RBA, they rely on data. He was talking about data, but back from in May. He's talking about the May unemployment rate. He's talking about these things. So that's 3 or 4 months ago. I mean,
it's a lifetime in our market.
That's right. That's right. So it's a case where our data points are very slow, unfortunately, and that's why it does make sense that the RBA need to be a bit aggressive with their interest rate increases, because they're accounting for 3 months, of past data. They're not accounting for 1 month. They've got to try and get ahead.
They've got to try and get out in front. And if they don't do that, then that's when the risk comes. So, look, I think, and I guess if people are looking for the complete answer, there is no complete answer, but we know what we know. The world is not coming to an end in terms of economically speaking. We're actually going through a big boom because of cheap cash. Yes, prices are rising. It's now phase 2, how they manage this part. And if you look back to, say, the 1960s, when there was also a similar event where central banks used monetary policy and liquidity to manage the economy, there wasn't a disaster. They were able to manage it quite succinctly. Now, you'd think 1960s to 2022s, we'd have a better version of that now. We'll have to see. When we talk to companies at the coalface, they're flat out. So I don't think we're going to see like a 1990s recession where growth just grinds to a halt. And that's what people associate with a recession. Do I think there are better times ahead? 100%. Do I think, we've made a rod frame back with cheap cash, and the central banks always overcook a turkey when it comes to stimulus and monetary policy. They always go too far. And we've seen this time again. And we shouldn't be surprised that the RBA is acting now when they should have been acting last year.
That's right.
US Fed's the same as well too. So to me, they've made their bed. They've got to sleep in it now in terms of trying to rein that growth back in. But don't forget, just because rates are going up doesn't mean they can't fall. So if they do raise them too quickly, then they can always do rate cuts as well too. So I guess to sum up this episode, I think is the best way to describe it, is do we think that there is more volatility in the Australian dollar? Because that's obviously what people are focused on this call. Yes. Do we think now's a good price? Bloody oath it is. Do we think it could go lower? Yeah, it could. So if you are looking to make that window transfer, lock a bit in today. Don't do the whole lot. Just lock a bit in. Get your toe in the water, get your foot in the door, and then review in a week's time. See how it goes. In another week's time, see how it goes. Month's time, you could see how it goes. But to me, you never lock in a price until you actually do the trade.
That's
so
right.
It's one thing to sit in the sideline, be the Monday morning quarterback, go, oh, this should have happened and I should have done this. That's all words. If you like it, if you like the Aussie at 68, take it. Exactly. A lot less than it was 72.
Oh, mate, 68 is great. Start dollar cost averaging, break it up. I mean, you don't really get anywhere with inaction, to be honest. So you might as well start now. I know and it's like that article that I did up a little while ago. Just inaction is not a strategy.
No,
exactly.
And
ahhing, waiting.
She'll be right. It's not a strategy. It's
yeah, that's right.
We should do that as a good episode podcast. Let's call out that future one. She'll be right. If she'll be right. Philosophy.
Oh, mate, I could give you a ton of examples.
Both good. You've got many years of experience in that. So let's wrap it up. In summary, for those on the call who are looking for that answer, should you transfer? Yes. How much is the question? We don't know. Could be 65, could be 63. Who knows? But 68 is still a good price.
Oh, yeah.
So take advantage. It is an opportunity. We don't know how long it's going to be here for. You know, the Australian dollar might be sub 70 cents to US dollar for the next 12 months. It could be for the next 12 weeks. We just don't know.
Yeah, absolutely, mate. All right, mate. That's a great episode. Thanks for dropping in.
Mate, we'll see you on the next one.
Sounds good. See you, bro.
Thanks, mate. See ya.